Hello, everybody, and welcome to Business and Life Insights. Thank you for joining us today. And we have a very exciting guest on board with us. Daniel Van Slyke is an attorney, and his firm is named iPlan Law. He's going to speak to us today about charitable trusts. So everything you wanted to know about charitable trusts, their advantages, and their uses to benefit not only charities, but the donors too. So Daniel, welcome aboard. Hey.
Thank you, Nell. It's a pleasure.
Very happy to have you. Pleasure is mine. Thank you. Yes, if you wouldn't mind just telling us a bit about you and how you became an attorney.
Oh, yes. So I started as a university professor. So I do have a doctorate, and it's in religious history. So when you get a law degree, it's also technically a doctorate called a Juris Doctorate. So I'm Dr. Van Slyke, but you don't have to call me Dr. Van Slyke. And so I love teaching, and I was teaching in basically religious institutions, so seminaries, colleges, universities, and I really grew a love for basically nonprofit education and supporting nonprofits, especially when you're teaching in them and you're trying to build programs. You really appreciate donors and all that they can accomplish. And I really thought at a certain point, I thought, maybe I could serve the institutions I love and the people I love even better by being an attorney than by being a professor. And so I made the switch, and I found that as an attorney, I still act a lot like a teacher. So I love opportunities like this to talk about what I do and to educate people. And I always approach what I do, the way a teacher does. So I get the comment all the time, you don't talk like a lawyer. But usually that's intended as a compliment. So I work in the estate planning arena. So I do estate planning, and that includes charitable planning for folks. And my goal is to help you achieve your charitable goals, reduce tax burdens, keep your estate and your family and your businesses out of court, and really basically preserve wealth in some cases, if that's your goal. I talk to people to figure out what their goals are. Preserve wealth for future generations sometimes leave a lasting legacy. So when you're talking about the lasting legacy, that's where the charitable planning comes in, whether it be a family foundation or a trust or anything of that nature.
Yeah, and just to add, Daniel is not just an estate planning or an asset protection attorney. He also works with businesses. So they, in many cases, work hand in glove because many people earn their wealth from their businesses. Do you find that to be the case, Daniel?
Oh, yes, Nell, absolutely. And not only that, but business succession planning becomes very important when you're doing estate planning, because a lot of people have their businesses set up in such a way that if the individual wasn't there, the whole thing would fall apart, or it would have to go to court, or there would be a battle over it. So I like to set up those businesses, and I integrate them into estate plans. I get them the documents that they need, help them kind of really think through issues about succession planning in business as well. And that's in the estate planning side. And on the earlier side, it's like, how do we set up our business to get the best tax results? And what state do we found it in? And do we want an S corp? Is it going to be an LLC? Those are fun puzzles that I love working with. I have a number of clients who have investment properties, and when you have investment properties, LLCs and trusts become very useful. LLC, Charitable Remainder Trusts, those are awesome vehicles for appreciated investment properties as well. If you want to get that out of your estate, you don't want to get hit with tax, sell it.
Sure. Right. So you can begin planning with business owners, their giving to help charities and causes that they care for, but also in some cases are some of those donations also deductible to the business if it's given on behalf of the business?
Oh, yes. Yeah. Businesses can get deductions for charitable contributions as well. That's why, many of them do, and many of them have make actually a large businesses tend to make large contributions. But even if you have let's say, what we call a disregarded entity, so it's a mom and pop organization, business, maybe a restaurant, maybe a hardware store, and the taxes are, flowing through to the owners. Again, any kind of charitable contribution they make can result in deductions. So income tax deductions, and also for those of high net worth, it can result in gift and estate tax advantages. But the income tax deductions are, you can just give to charity and then receive a deduction. So as long as you're giving more than, the standard deductions that the IRS has, I think it's around $23,000 for a married couple filing jointly. But above that, if you're giving to charity, you can get an income tax deduction in that year when you give. So very, very important tool for a lot of people to try to reduce their income and even get into a lower for tax.
Get into a lower tax bracket, and they can give as an organization, as a company, or they can give as an individual.
Yes.
Correct. Yep. Right. And that can be a very good strategy for many families. So
and that's the straightforward way. So if you do that for a income tax deduction, that's great. You get it. It's kind of one and done. Charitable remainder trusts are more sophisticated, and they'll give you a stream of income, so you have something coming back to you for future years.
Oh, well, that's nice. What a nice benefit that would be.
It can come back to you. So it's should we go ahead? I'll let you determine the next question.
No. I'm just following your lead. I don't want to break up the thought, because we can revisit this too later. But I also want people to know this: you work in 3 states. You're licensed to practice in 3 states.
Yes. So California, Texas, and Missouri. I do, most of my work is virtual, just like this. I appear with people on Zoom, and I get to know family, estate, business, investments, and then help folks to achieve their goals, whatever they might be. I can work with people that are in Texas. I have a lot of clients in Texas. I can work with folks all over California, although I am based in the Pasadena area. So that's my basis of operations. If you want to see me, generally, it's going to be in the Pasadena area. I do get to the Dallas-Fort Worth area of Texas with some and I also have clients in Missouri. So all places that I've lived and loved. So I just live a licensed attorney, and I took the bar exam 3 times, and I passed it every time. So. Different states.
Oh yes, you must be pretty good at it. You must be pretty good at your practice.
Yes.
Having being licensed in 3 different states, and maybe you could talk to us about the difference for charitable trusts. Are they different between the 3 states?
That's an interesting question, and let me say that there are 2 levels here. The basic answer is no, and why is that? Because most of your laws governing charitable remainder trusts or charitable giving, a lot of that is federal. So when it comes to federal law, that's the same no matter what state you're in. And so most of what I'm going to talk about today is going to be about federal law. So in that respect, it's all the same. Now, on the other hand, there are differences with regard to taxes in states. So for example, Texas has an no income tax, right? So your charitable giving is not going to save you on state income tax if you live in Texas. It'll save you federal taxes, but it's not going to save you state taxes. And on the other hand, California has an income tax, which is considerable. Missouri also has an income tax, but the way that they handle the deductions, it basically tracks the federal, but you may get some differences in, the amounts and the calculations and the treatment between those different states. But most of what I'm going to discuss today is the federal, and so it would apply equally federal law in all states. So that's the IRS, right? So when you're filing your annual taxes, everybody has to file.
Okay. Yeah, very, very good. So walk us through some of the criteria you use when you're recommending a charitable trust to one of your clients. What are the steps that you take?
When a client approaches me about a charitable remainder trust, or any kind of charitable giving, it's often in the context of a discussion about either estate planning, or sometimes somebody has a large amount of money, like a liquidity event. What's a liquidity event? Let's say you've been working on a business for the last 5-6 years, and suddenly somebody, like a tech startup, and somebody buys it out, and you wind up with $10 million. Mm-hmm. That's a big amount of money to receive in 1 year, and you're going to get hit with a huge tax bill, and bigger in a place like California because of the state taxes. So in cases like that, people might say, well, what can I do to reduce my tax burden this year? Because I have this big influx of money, and a lot of it's going to go to Uncle Sam or Uncle Gavin if I'm in California. So what can I do to reduce that tax burden? So sometimes people come to me and they actually are not as interested in supporting the charities as they are in reducing their tax burden. And I can help those people, but I do believe that because you can't predict the future, and while in most cases, I think if the charitable trust is properly and carefully planned, you will save on taxes and have more money in the long run. In some cases, it doesn't turn out that way. Like if you die unexpectedly in the next few years, you might not get the advantages you were expecting from a stream of income from a charitable remainder trust. So I do the best thing, I think, is and they're best for people who really have charitable intentions. So these are people who have causes that they genuinely want to support, or maybe have been supporting for a long time, and those are going to be the better candidates, because even if they don't wind up making out better in the short or long term financially, they're happy because they supported their charity. But in reality, most of the time, these work out really well, and you wind up with a big tax benefit. And in the end, more money in your pocket than you would have had if you hadn't set it up. Now, the other thing about the Charitable Remainder Trust is you really want to put a fair amount of money into it. And why is that? Because it's costly to establish. You're going to have experts every step of the way. You're going to have an attorney help you with the trust. You're going to have a tax expert, CPA or something like that, to file taxes for you every year. And I would say you should have an investment advisor, things of that nature. So there are a number of professionals you're going to need. And so you really want to be sure that the money that you would have to put into it is going to be worthwhile. Because if it's a smaller amount, just make a gift to charity. But again, for the fellow who sold a business and has 10 million, yeah, he could get huge tax benefits out of this. And the cost of the setup would be well worthwhile.
All right. So say if they're in the 35 or 40% tax bracket, that would be the savings that they would receive. 40% of the donation comes back as tax savings. Am I correct?
Well, not quite. Tax savings this is where it takes sophisticated software and calculations to come up with the exact tax savings. It's not dollar for dollar. So it depends on the value of the property you contribute. So obviously, if it's cash, that's easy to value, right? It's the cash value, or if it's marketable securities, your stocks and bonds or something like that. That's easy to value. But then if it's something like real property, then it needs to be you actually need to have an appraisal, and then the IRS may want to see the appraisal. So you definitely want to keep it on hand and have an accurate appraisal so that when you make that donation, it goes in. So then what's the value of the property? Is it long-term capital gain? That will make a difference. How long does the trust last? That's going to make a difference. What sort of charitable remainder beneficiary receives? That will make a difference. All these factors go in to determining the exact extent of the tax savings. And let me explain the basics of the trust first, because this is good.
Okay. Yes, please. Thank you.
Step back before we get into the weeds, but just to answer the question, it's not dollar for dollar. Okay, so you're not. So
thanks for the clarification.
Here's how it works. Charitable Remainder Trust. You've got several people or institutions involved. So here they are. The grantor or the donor. That's the person who puts money into the trust. Okay, so that's the person who wants to support a charity and really wants to have some tax savings as well. So you're a grantor or donor. Number two, you have the lifetime beneficiary, or the income beneficiary, I should say. So that beneficiary will receive payouts from the Charitable Remainder Trust for life or a term of years. So the term of years can't be more than 20. And life, the tax deduction is going to be larger if the person is older than if the person is younger. Okay, this is the lifetime beneficiary. It's not a charity. So the lifetime beneficiary could be yourself. The grantor could be the lifetime beneficiary. And also the grantor's children could be the lifetime beneficiary, or the term beneficiary, so the non-charitable beneficiary. So those are your first two people, the grantor and then the non-charitable beneficiary. And then finally, third is the charitable remainder beneficiary. Why do we say remainder? Because what's left in the trust at the end of the term goes to the charitable remainder beneficiary. So that's a charity. That charity could be a 501c3 charity. That gives you the best tax deduction. If it's a private foundation, you get a lower tax deduction, just in general. So some people wonder if they can support their private foundation. Well, possibly, but you're going to get a lower tax deduction for that. So here's where your tax deduction comes in. You're getting a tax deduction for the value that goes to the charity at the end of the term.
Oh.
That's what's getting you the tax deduction. So, and that should be at least 10% of the value of the trust. So there are rules governing how much should be going there. Now that value, though, it's not the exact value that they get, but it's the value that's calculated when the trust is first put together.
Mm-hmm. Right. And so is that value then deductible over the term of the trust, or is it a one-time tax deduction? It's an obvious question, but
I hate to be so lawyerly in my answers, but it's, I mean, neither, both.
It depends.
In the first, you get the tax deduction in the first year if it's an income tax deduction. Now this can be huge if you have a big influx in your income because you just sold something valuable. But it can be carried over for 5 years. So yeah, if it's more than you would benefit from in the first year, then it can be carried over for subsequent years. So that's the answer to that question. And that's an income tax deduction, but it also has advantages from the estate planning side of things. So if you have a taxable estate, and I don't think we need to get too much into the details of that, but this year, that means over 26 million, but that's the highest it's ever been. And this could change the estate tax exemption. But if you have a taxable estate and you put assets into the Charitable Remainder Trust, that actually reduces your taxable estate. So you don't any longer, that's not going to be taxed when you pass. It's out of your estate. And so assets grow and grow, and your non-charitable beneficiaries are receiving nice payouts from it for the term of years, then all that's not in your estate, and it's not eating away at your gift or estate tax exemptions. So that's another big benefit of these. Now, if it's coming, it is taxable as it's paid out. So this is where it really takes a lot of calculation to determine, what are the tax savings of these things. And this is not a do-it-yourself type of thing, because as it comes out, it's taxable. And have you ever seen the Internal Revenue Code? No.
Stacks and stacks and stacks.
Thousands and thousands of pages of the Internal Revenue Code. If you ever have trouble sleeping at night, just pick up the Internal Revenue Code. It's affectionately known as the IRC. So this is what the IRS service uses. It's kind of their Bible and how they tax us with everything. So it's complicated, and trust taxation is complicated. You definitely need like a CPA that knows how to do these calculations. But when payments are made during the term to the non-charitable beneficiary, the non-charitable beneficiary may have to pay taxes on those payments. So there are 4 tiers of distribution. So one of them is income. So if it's income for the trust, and then that's got to come out first, and when that goes to the beneficiary pays a tax on it. So then you get down to so I won't go through all the tiers, but a couple of the last tiers, one of them may not be taxable, one of them is not taxable. So principles, what went into the trust in the first place, when that's being distributed, that's not taxed. So there is a tax consequence and this is income tax consequence for the non-charitable beneficiaries when they receive the payouts. So whatever payouts they receive each year are going to be added to their income, and depending on the source from the trust, they may be taxable.
Right. So we've been talking about the Charitable Remainder Trust.
We have been, yes.
And it has a sibling.
It does, yeah. The Charitable Lead Trust.
Yes.
Is its sibling. And the way to think of this is, does the charity get the remainder that's left at the end of the term? Or does the charity get the lead payout during the term? So the question is, who receives payments first, the charity or the non-charitable beneficiary? And with the Charitable Lead Trust, it's the charity that receives the payouts during the term.
Oh.
And then the non-charitable beneficiary receives what's left at the end of the term.
Right. Yes.
Yeah, and that's a bit of a different planning strategy. So that's chiefly used. Here's the interesting thing, and let me just tell you I'll tell you the overall fact, and then dig into the reason why. Charitable remainder trusts tend to be smaller and fewer, right? But there's more money in charitable lead trusts. So this is, practically speaking, if you look at the number of charitable lead trusts, they're very large. And why is that? I mean, not the numbers of charitable lead trusts, but the amounts of money in them. Because charitable lead trusts are more of an estate tax saving strategy for very high net worth individuals.
Oh, okay.
Yeah, and they can be used. They can be used. I sometimes tell people that estate taxes are optional because you can zero out. You can structure your charitable trusts so that at your passing, your estate tax is fundamentally zero, because whatever would be taxed, you're giving over to charity. And with a charitable lead trust, that's great. It all goes in there. It's not taxed. And then maybe 20 years later, you might have a windfall of untaxed remainder interest going to your non-charitable beneficiaries, which is pretty nice. Yeah.
It is pretty nice, yes.
So the estate doesn't pay tax. The non-charitable beneficiaries get a big payout at the end of the term. And in the meantime, the charitable beneficiary for a charitable lead trust is receiving payouts. Now, obviously, the charities love charitable lead trusts. They wait to get paid. They're getting paid every year.
Yes.
Whereas with the charitable remainder trust, they're at the end of the line, so they've got to wait maybe 20 years, maybe longer, maybe longer, depending on the term. So charitable lead trusts tend to be more estate tax planning strategies for high net worth individuals, whereas charitable remainder trusts are often used by people who have large income and are looking for income tax savings.
Okay.
Yeah.
Thanks for drawing the distinction.
Absolutely. And one of the differences too is in different interest rates. So I haven't gotten into interest rates yet.
Oh, okay. I guess we need to go there.
Yeah, we kind of do, because that's one of the factors also that determines the amount of your charitable deduction. And, every month we have the AFR, the IRS introduces its interest rates, right? And these charts, it publishes them. But every month the IRS introduces an interest rate, and whether those interest rates are higher or lower makes a difference in the charitable deduction. So, yeah, because the idea is that if the interest rate is higher and you have a charitable remainder trust, then you would expect, and the way the calculations are done, you would expect more to go to the charity at the end of the term.
Wait, that's the earnings, the interest earnings.
Because it's going to keep growing. Yeah.
Okay.
Yeah, so that's why the interest rates matter, and in different environments and different interest rates are, so if it's higher, then you get, again, the expectation is that it's going to grow more,
Right.
and so there'll be a greater amount of a tax deduction.
Right. So maybe just to round out the team that's putting this together, there must be some kind of fiduciary who's implementing all of these.
Yes, that's a good point. Yeah, I left out the fiduciary. So the fiduciary is the trustee. The trustee is in charge of the trust. And the grantor who put money in there could be the trustee.
Okay.
He can, or she, but not necessarily. They may not want the headache because it's a lot of math and a lot of calculations. But if they can do it, they have to be careful also not to engage in self-dealing with the trust, because you don't want to blow your tax exempt status.
That's right. So it becomes, it disqualifies the trust if anything goes, is done that's not legal. Correct? Right.
And so it's easy to, again, because it's so complex, it's easy to mess up. So, and that's where the expense is a little higher for these things than you would expect with trust, because you really do want to have a professional. I mean, I would recommend a professional trustee. And there are banks and professional trustee services.
Banks can act as trustees, or
in some cases.
in banks, or investment houses can act as trustees. And there is something called a certified investment trustee or a certified charitable trustee.
Yeah, we have certain fiduciaries. There are professional private fiduciaries. Some of them would specialize in this area as well. In California, they're certified by the state. We have that in every state, like Texas doesn't have it. So the trustee is an interesting question. Somebody's got to be in charge of the trust. So those are your, overall the people involved, if you will, the grantor, the trustee,
Mm-hmm.
the non-charitable beneficiary, and then the charitable beneficiary.
Mm-hmm. Mm-hmm.
And a lot of charitable beneficiaries, including large universities, they will do all this for you. They'll set it up for you. They will take care of being trustee. They will make the distributions, and that's very attractive for a lot of people because they don't have to give it the headspace. So let's say that you're a graduate from such and such university, you love your alma mater, you want to support it, you have a big windfall and you need a charitable remainder trust, or maybe you're even doing some estate tax planning and you want a charitable lead trust. So then you go to that university, and if it has a big gifting department, and some hospitals will fall in this category too. So it tends to be larger nonprofit organizations.
Mm-hmm.
Have in-house folks that can do all this for you. They will set it up. They will be service trustee. They will make the distributions, take care of the investments, and at the end they'll get the remainder. They love that because it locks them in as the remainder beneficiaries, as the charitable beneficiary. So in other cases, though, if you set up your own and you use an attorney, you can usually set it up so that you can change the beneficiaries. And a lot of people like to keep this control because they may love their alma mater, but they may not love some of the things that the university is doing now, right? Like they may find some things that are happening on the campus absolutely objectionable and no longer want their money to go to that school. Mm-hmm. But if they set it up on their own, they can change the beneficiary.
Oh, interesting.
Yeah.
Really? Yeah. We maintain control over the trust, and it can be changed at any time. It probably requires a lot people getting together again, mm-hmm. and at an expense to change the trust. I would think.
Yeah, usually it's while the grantor is alive and well, right? And then because these are what you call irrevocable trusts, meaning that once you set up the trust, you fund it, you put money into it or other assets, you can't shut it down, right? So. But you can set these up so that the final charity can be changed.
Okay.
So the grantor can change the final charity. Now, you do have to be careful, let me just say, because remember we mentioned before that the tax deduction changes based upon whether it's a 501c3 charity or whether it's a private foundation.
Mm-hmm, mm-hmm.
So you want to be sure that it's not set up so it can be changed to a private foundation, or the IRS will reduce the tax deduction based on that.
Right, so it has to be in the same category, either a 501c3 or a private foundation or one of the.
Yeah, private foundation reduces your tax benefit, so you want to make sure that you can't change it to a private foundation if you're really looking at tax.
Stay with the 501c3.
Yes. Yeah, and by the way, 501c3, like so many of these other numbers that we throw around in tax planning and estate planning, that's from the Internal Revenue Code. So it's a section of the Internal Revenue Code that talks about nonprofits. And so that's where that number comes from.
That's some more bedtime reading.
Exactly. Very good bedtime reading if you happen to be tired.
Well, you're explaining things so clearly, Daniel. I really appreciate that. And I want to ask you, can you talk about one of your more interesting cases that you've handled? Let us kind of, maintain confidentiality, of course, but if you could just walk us through some of the interesting little ins and outs of one of the more interesting cases that you have handled.
Sure. Yeah, I have had, so I had a case where there were siblings involved. They owned a business. Mm-hmm. The business was pretty valuable. So they were selling the business for $10 million, mm-hmm. give or take. Uh-huh. And they were primarily interested in reducing their tax burden, right? Because the problem they're facing. So I wouldn't mind having this problem. I don't know about $3 million being thrown at me, 3 million, 3.3 million in 1 year is a nice problem to have. So
Yeah.
that's one thing to keep in mind when you're looking at this charitable planning on this level, when you're at the level where you're thinking about a charitable trust of some sort, you've got a good problem.
Yes.
So 3.3 million being thrown at each of them, but they're looking at a pretty hefty tax bill because that's going to be, they live in California. So in California, they're going to get hit with a capital gains tax on that. And capital gains, because they basically have zero basis in the company. So the company wasn't worth anything when they founded it. Now they're going to sell it. And basically that's $10 million in capital gain. And capital gains tax is pretty high. So they need a way to reduce their income in that year. And so how do they do it? So you put together a charitable remainder trust. Now, here's the great thing. This can really significantly reduce their tax burden. And then they set it up so for the next 20 years, they're receiving payouts. So they're receiving an income stream annually for 20 years. And that income stream, the way the numbers run, that income stream is going to give back more than they put into the trust. So when you add up their tax savings and the income stream, they wind up ahead financially, which is beautiful. And then at the end of the term, at the end of the 20 years, their favorite charities receive the remainder. So it's really a sweet deal. It's a very sweet deal. And let's say that they go on to make another, however many millions of dollars. And I have had clients that do this serially, like they continually build very valuable businesses and sell them. And then they have genuinely taxable estates at the end. Again, all that they put into these charitable remainder trusts, that's out of their estate. Mm-hmm. So, and the immediate advantage is instead of paying all that tax in the year of the sale, mm-hmm. they're paying less tax, but gradually over the 20 years of the term as the distributions are made to them. So they're not necessarily catapulted into the absolute highest possible tax bracket every time.
Right. Oh.
Yep.
So that's a beautiful design.
Yeah, it's beautiful. Yeah. Now I'm glad you put it that way. They're very beautiful about these charitable trusts. I think they're beautiful in a lot of ways. I mean, mm-hmm. There's a harmony of numbers, right? In the harmony of numbers, but also tax savings. I'm all for tax savings. I do believe that not in every case, but in a lot of cases, charities can more effectively serve people than government. So I'm all for shifting money, and the government incentivizes these charitable giving with these tax breaks. So obviously there's something very inherent in our system, which wants to support charitable giving. And so that's beautiful too. And the supporting of the charity is beautiful. The saving on taxes is beautiful. And the income stream is really wonderful. And these things can be set up. Are you ready to get more complicated?
Oh, no, it's okay. Yes, please.
So charitable remainder trusts come in two kinds of varieties. Okay, they come in two varieties. There's the CRT and the CRAT. So they both have CRT, right? Charitable Remainder Trust. And then the CRAT is the Charitable Remainder Annuity Trust. The CRT is the Charitable Remainder Unit Trust. So what in the world does that mean? So let's start with the CRAT. The Charitable Remainder Annuity Trust is paying the same amount to the non-charitable beneficiary every year. So you know what the non-charitable beneficiary is going to get. The Charitable Remainder Unit Trust is paying an amount that is based upon the value of the assets in the trust. So what does that mean? That means that you have to value the assets every year. Yeah, so that may be, that'll probably be more expensive if they're difficult to value assets, right? like if it's a business interest or it's real property and you have to pay an appraiser every year, that's more expensive. But the neat thing with the CRT is that it comes in these varieties, and just for laughs, I'll throw them out. There's the S-CRT, NI-CRT, NIM-CRT. And they get pretty complicated, but the neat thing about these is you can set them up. Like, let's say you do kind of a flip CRT. Think of the flip as a switch. So when you hit the switch, it starts making payments to the non-charitable beneficiary. So, for example, you can say you're in your 60s and you receive this big windfall. Maybe you even win the lotto or something like that. That's a big tax bill, by the way. Don't spend that money before you pay your taxes. Don't spend any of it before you figure out the taxes if you ever do win the lotto. Now, be careful. Yeah, there's so many stories of people that are they're poorer after winning the lottery than they were before, because now they owe millions to the IRS. So let's say that you receive that windfall and you're 60 years old and you found a flip CRT, and you can set that flip CRT up so that it starts making payments to you as the non-charitable beneficiary when you retire. So you've deferred taxes. You've gotten a tax advantage when you put money in there. You haven't just deferred it. But you've gotten a tax advantage when you put money or assets in there, and then it can wind up paying to you during your retirement when you need the money, but not while you don't need the money, because you have, you're working and you have other sources of income. So really neat tricks you can do with the Charitable Remainder Unit Trust.
Unit Trust.
Yeah, and again, without getting into the details of how that works, you can set it up more or less so that a switch can turn on and it starts making payments to you.
Wow, it's a self-governed retirement plan.
Yeah, it can be seen as, it saves you taxes and then it works in your retirement. Absolutely. Yeah, and similarly, the CRT has to keep making a payment every year of the term. So it's not, you don't have those options with the CRT that you have with the CRT. So the Charitable Remainder Unit Trust is a bit more flexible than the Charitable Remainder Annuity Trust, but it also can be less predictable as to what the non-charitable recipient receives.
Right, because there's an annual valuation that has to take place.
Exactly, yeah.
Right, and that there's a time limit of 20 years for both. Did I hear that correctly?
It's 20 years or a lifetime. Okay. Yeah, it can be measured by somebody's life. But if it's measured by a life, you have to be careful, because here again, we get into the IRS. And if you ever want to have, go googly-eyed, take a look at their life expectancy tables. Because they've got it all figured out. Like, if we're so and such of an age, exactly how long we're expected to live, and the tax consequences of our projected lifespan. So that's what they'll look at. They'll look at those tables if you're such and such an age, and their tables help determine how it is that, what kind of tax deduction you're going to get. So if you have a really long life expectancy, you're not going to get much of a tax benefit if, you don't want to make a 12-year-old the beneficiary of a Charitable Remainder Trust. As a matter of fact, it's probably not even going to be possible, because there are rules that 10% has to go to the charity in the end. And it's unlikely, if payments are being made that long, that unless you have a really high interest rate, I suppose.
Do those life expectancy tables change ever?
They do, yeah. Yeah, the IRS will change them every now and then. So the general change is because people are expected to live longer with each passing year. I don't know if that's always going to be the case, but the past changes have been made on the basis of people living longer. But these same types of tables are used when people are determining their required minimum distributions for retirement accounts. For example. So when you retire, at a certain age, you have to start making withdrawals from your IRAs or your 401ks, your traditional IRAs or 401ks, as opposed to the Roth IRAs or 401ks. There are required minimum distributions, and the way they're determined is based upon these tables and your life expectancy. And the IRS wants you to have made all the distributions and then die without anything left in there. So that's usually how the tables are calculated. Now,
precision planning.
Well, it usually doesn't work that way exactly. And then if you do die, always before it's paid out, you want to check your beneficiary designations. Very important. If you have IRAs and 401k, double check your benefit. I'm going to say speaking to you here now. Double check your IRA beneficiaries and your 401k beneficiaries.
Yes, for sure.
Yes.
So this is really a pretty minor, a detailed question, but is the life expectancy table locked in the date that the trust is established, or do we have to worry about the life expectancy changing?
Yeah, because that's the year that you're going to get the tax deduction and it's calculated, right?
Okay, so that's the determining life expectancy table that's associated with the trust.
Yeah. So future changes in the IRS's life expectancy tables are not going to change tax benefit when you establish the trust.
Like, this is really interesting.
Now, I knew I reached a turning point in my career now when I started enjoying reading IRS publications. Oh, no. I used to read ancient Latin authors now for fun, and now I read IRS.
IRS tax code. Oh.
Like ancient
IRC and the IRS.
But not for work anymore. Yes. So let me talk about one more benefit, if I may, of Charitable Remainder Trust, and that is capital gains. Okay, so there are a few ways to you can defer capital gains, but let me explain first what a capital gain tax is. So let's say you buy a house for $100,000, and then you sell it 20, 30 years later for $1 million. So that happens in California, but just even numbers. And let's say that you put $100,000 of improvements into that house. So your basis is what you invested. So it's $100,000 that you paid for it plus $100,000 of improvements. Okay. But you sold it for $1 million, which means you realized a gain of $800,000. You have to pay tax on that $800,000. And that tax, again, we have kind of a graduated tax system, so it's complicated to say how it actually works out, but it can be pretty high, depending on the state where you live, because there's the federal tax and then there's state taxes. And so when you sell the house and you realize the $800,000 gain, you have to pay that tax. But there are a couple ways that you can mitigate that tax hit. So one of them is what you call 1031 exchange. So let's say it's an investment property. It has to be an investment property. Maybe it's a rental that you rent out to people. And you 1031 exchange it, meaning you buy another house of the same value with the same debt, and then you've deferred your capital gains, so you don't have to pay it that year. So that's a deferment. But with a charitable remainder trust, what you can do instead is you can take that property and you can contribute it to the trust. So the charitable remainder trust then can sell the property and it does not realize a capital gain, which is a pretty sweet deal. So the charitable remainder trust has all that money to reinvest. So let's say that for the sake of argument, you had to pay about 50% in capital gains tax. I mean, that's a little higher probably than it would be in reality, but not too far off, especially depending on the laws. They change all the time. So that means that $400,000 would go to taxes. So you would be left with $600,000, right? So then you could invest $600,000 in the market. But imagine if you could invest $1 million in the market instead of $600,000. That's a lot more investment power, right?
Yes.
So when you contribute the appreciated property to the Charitable Remainder Trust, it has $1 million to invest. That's nice. So you can actually use the Charitable Remainder Trust. So this isn't a windfall scenario or selling a business or winning lottery or something like that. This is a scenario where you have appreciated property to deal with, and you contribute it to the Charitable Remainder Trust. And now the Charitable Remainder Trust can reinvest that entire amount. You get a tax break, and then you get payments. Now you're going to be, for the term of years, let's say 20 years, or maybe you want to give it to your children. I don't know. Some non-charitable beneficiary is getting payments based upon the investment of that entire amount. And then at the end, the charity gets the remainder interest. Whatever's left at the end of the term all goes to charity. Everybody benefits from that. The non-charitable remainder beneficiaries are getting more. The grantor avoided a capital gain realization, and then the charity in the end gets more. So there again, that's a beautiful thing now, a really beautiful thing.
Oh,
so
absolutely. And I can see where that could benefit a lot of people in California who have been in their home for the last 50 years.
Yes, yeah.
For example.
Yeah, this is another issue in California is right now, especially with these investment properties, Proposition 19, which passed a few years ago. If you want to leave an investment property to your children, they're going to get reassessed for property tax purposes. So to put this in perspective, what they're paying in property tax is based upon $100,000 that they first paid for that property, which is increasing at maybe a rate of 2% a year. The rate of increase is capped by California law. But now if it's worth $1 million, it's going to get reassessed, and your heirs are going to be paying property tax as if it's worth $1 million.
Oh,
so that should be a huge increase in property tax, and that's extremely problematic now that we have all these. Every month it seems that a municipality or the state or somebody passes another rent control law. So you might leave a rental property to your children, and now they have a much higher property tax bill, but they can't increase the rent to pay it. So they could be at a point where that house is just a liability. That rental property is just a liability. So what do? You could contribute that to a charitable remainder trust, have the charitable remainder trust sell it, and then have it pay out to your children while you're still alive. That's one option to avoid that dilemma of the reassessment of the property in California. Because when you're talking huge appreciation, like where you're going to have a big tax realization upon sale, a lot of times it's a place like California. Yeah, Texas properties have gone up in value, in part because so many Californians are moving to Texas. Not as much as what you see here, where somebody might have paid a couple $100,000 and might be worth $1 million. And then that's in parts of California. Obviously, it's not all California, but. Yep.
So this capital gain scenario could play out for any kind of appreciated property, real property or investment property, or
even
stocks or bonds.
Even odd things like art. You may buy it when the artist is a nobody, and then maybe 10 or 15 years later the artist is famous. Even art can be contributed in this way. Okay. Yeah, and I don't want to get into the details, but you would use a CRT for that probably instead of a CRAT. Trust, because otherwise you would have to sell the art right away. You could sell the art right away, but yeah, any sort of property really, except you do want to keep in mind that some things like S corporations, probably not, but for the most part, any kind of property.
Oh, interesting. My gosh. Daniel, you've been a wealth of information. And also, you're just really fun to listen to and to learn from. You're very animated and explain things so clearly. I can see your professorial skills are coming through loud and clear.
Thank you. Yeah, I miss teaching. I really miss teaching. I don't miss grading papers. And I don't miss faculty meetings, but I really miss teaching.
Are there any final words that you'd like to leave us with before we close the show?
Well, I would just encourage, if you have a charity that you want to support, if you have a cause you believe in, there's a way. I mean, even, right now, anybody can make a donation to charity, but it's not necessarily, you wouldn't necessarily deduct it because we now have those standard deductions, right? So if you're going to give a significant amount, you want to start itemizing your deductions. Remember, there are other things that are deductible too, like mortgage interest payments, medical expenses. And when you add those to charitable contributions, you can still get tax deductions if you go over the standardized and then you start itemizing your tax deductions. So that's something to talk to your tax preparer about. But I do encourage people to really consider the tax implications of donations to charity if you're charitably inclined. And if you have a significant amount, or you're realizing a gain, or you have appreciated property, or you're suddenly have an influx in cash from a liquidity event or an unexpected, lottery winning or something like that, I mean, I highly, highly recommend considering these charitable trust planning options, because they can be wonderful both for achieving your philanthropic goals, for founding a legacy, leaving a lasting legacy of helping whatever your favorite charity is, and also for saving taxes. And so that's the win-win of the charitable trusts.
Yeah, nicely said. Nice summary too. And I just want to encourage anyone who's interested in this to contact Daniel for more information. He's a wealth of information and really great to work with. I can attest, as you can see.
Yes. Now you're a great pleasure to work with. I always enjoy bumping into you.
Oh, thank you.
I know a lot around the Pasadena area, so
that's right.
Always a pleasure.
Yeah, we bump into each other often, which is a good thing.
Yes, indeed.
And every time and you may not know, Daniel's got you probably can tell, he's got a great sense of humor.
I'm refraining from the dad jokes during this talk, though.
Okay. I'm encouraging him to write his joke book on all kinds of topics. And he's got a lot of lawyer jokes that are funny, and they're great for his company.
Yeah, well, you know what they say, there are actually only 3 lawyer jokes. All the rest are true stories.
Go for it.
All right, thank you, Nell.
Yes, thank you so much, Daniel. And everybody, I invite you to join us again next week, where we're going to be treated to a happiness coach from South Africa. So join us next week and we'll learn all about being happy.
Good time.
All right. Good night. And thanks, everyone. Have a great week. We'll see you next time. Very good.
Thank you.
Okay.